This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Well, in our previous sessions dealing here with the bases of assessment for the unincorporated trader, most of the problems have existed about determining what the assessment should be in the opening years of the new unincorporated trade. Well, thankfully, as we promised at the end of the previous session, dealing with the final years of an unincorporated trade and determining the closing years rules are a whole lot more straightforward. Now, as the statement says here, again, much more straightforward than opening years. Now we know what CYB is, at least I hope we know what CYB is used up to and including, there's a lovely word, the penultimate tax year. That's the one before last. So to be able to work out what tax year is the penultimate tax year, we need to know which is the final tax year. And that's very easy because the final tax year will be the tax year in which we ceased trading. If you remember the way in which we went about dealing with an opening year's problem, the first thing that we did was look at the start date. And the start date gave us our opening tax year. So it is with closing years when we detect in a question that we're dealing with the cessation of an unincorporated trade. The first thing you do is to pick up what was the cessation date, and that therefore will determine which is the final tax year. If you know the final tax year, go back one and you come to the penultimate tax year, and that year will be assessed using your normal current year basis of assessment there. So in terms of the steps that we take, the first step, identify which tax year is the final tax year based on the date of cessation. So step one, identify the final tax year based on date of cessation. So that's an easy enough step one. Step two, go back to the penultimate tax year, the one before last, go back to the penultimate tax year and assess using CYB. That is two of the three steps that we need to apply here now dealt with, because all that now happens is that the basis of assessment for the final tax year is simply to include any other remaining profits as yet unassessed. So we want the actual trading profits from the end of the basis period for the previous, i.e. the penultimate year of assessment, all the way through to the date of cessation, i.e. all of the profits that have not yet been taxed, all the profits that have not as yet been taxed. One final thing to do in this final tax year, as we mentioned when dealing with opening years, any overlap profits, or now we may refer to it as overlap relief, that arose within the opening years of the trade will be deducted in deriving the assessment for our final tax year. So a simple three-step process that you will always be able to apply. Step one, look at date of cessation. Date of cessation fixes for you the final tax year. Step two, go back to penultimate tax year and assess using CYB. Step three, all remaining profits, so anything as yet unassessed, list out any remaining profit. Now, that will be either one or possibly two accounting periods of profit. But list out any remaining unassessed profit and reduce it by any overlap profits that we are told arose within our opening years. Or if we've got to do a long exercise going from opening all the way through to closing, we may indeed have worked it out for ourselves what the overlap profits were. Okay. Again, the proof of the pudding, as they say, is now in the eating. So let's have a look at an example. And again, just as we were doing with opening years, here we go. Here is an example that I've set up for you. So again, note down the information here as we go through. What you can see is that on this occasion, a trader, a taxpayer, has always prepared accounts to the 31st of December in each year. And the last two such years ended December were December 14, where a profit of 40,000 as adjusted for tax was made, and then the year ended 31st of December 15, where we had a tax adjusted trading profit of 36,000. We then, or the trader then, continued to trade through to the 30th of June 16, and at the 30th of June 16 ceased trading, and in that final period made a profit, again tax adjusted, of £16,000. We are further informed that from our opening years our overlap profits amounted to £6,000. So with that information, we now need to work out the assessments in the final tax years of this trade as far as the available information provided will allow. So remember the technique. Step 1. Look at the date of cessation, 30th of June 16. So in which tax year did we cease trading? Very obviously, that is the 16-17 tax year. So we would note, in terms of step 1, what our final tax year was. We would then, having noted it, leave space of probably 4 or 5 lines here on your working page for your answer, and go back to the penultimate tax year. Only now do you know that if 16-17 is the final year, then the penultimate year must be 15-16. And that you will assess using CYB. Now, to what date has the trader prepared accounts? The trader has prepared accounts to years ended the 31st of December. So there you go. You now need to use your basic CYB. Which 31st of December ends within the 15-16 tax year? And that, of course, is the year ended the 31st of December 15. What profit arose in that period? Year ended December 15, £36,000. So there we go. We have our CYB assessment, £36,000 for the 15-16 tax year. Clearly, given the information provided, we could see it there. Year ended December 15, that was going to be 15-16, and the year ended December 14 would be 14-15. So we could go back one more year to the 14-15 tax year. CYB, year ended December 14, assessment £40,000. But let's now, having gone back to 15-16, sorted out the penultimate year. That's step 2, remember. So step 1, what is the final year based on date of cessation? 16-17. Step 2, go back to the penultimate tax year and assess using CYB. Step 3, the final step, list out any and all remaining profits as yet unassessed. Now there is only one such period, the period through to the 30th of June 16 there. The period to the 30th of June 16. What was that profit? There we go, £16,000. There was no other profit, there's just that one period of profit there, and from it we must deduct less our overlap profits or overlap relief. How much were our overlap profits? £6,000. Now that is deducted. We deduct. It is less those overlap profits. Take the 6 from the 16, very obviously therefore, £10,000 is now the assessment in the final tax year. So look again at and learn those steps. Step 1, pick up in the question the date of cessation, which is the final tax year. Note it and move back to what then is the penultimate tax year. How do we assess it and any years prior to it? CYB. How do we get the CYB assessment? If we've prepared accounts to the 31st of December in each year, and we now want the 15-16 assessment, that is the year ended December 15. Pick the figure up, note it, and now move back to the final tax year, and we will assess any remaining profits as yet unassessed. Well, we've come as far as December 15, so there was only one final period to list out, June 16. Take away the overlap, and we have our assessment for the final tax year. The job is complete. Now again, take a moment, just pause here and go back through that, make sure that you're happy with it, and then we will have another exercise, one more example to illustrate this. I'll take you through that, and again I'll prepare that while you revise through that exercise. So pause for the moment and then we'll move on to the next one. Okay, so here's our next example where we see that the trader has always prepared accounts to the 30th of June in each year. Recent such year ends have been the year ended 30th of June 14, where we had a tax adjusted trading profit of £50,000, followed by the accounting year ended the 30th of June 15, where we had a tax adjusted trading profit of £30,000. We then had our final period of trading through to a date of cessation. Here's our date of cessation, critical starting point, of course, in working our assessments, through to the 31st of March 16, in which, again, a tax-adjusted trading profit of £25,000 arose. We're further informed that from our opening years, we had overlap profits that arose of £9,000. Overlap profits of £9,000. So armed with that information, we now need to work our assessments for the final tax years, as far as the available information provided will allow here. So how do we do that? Remember, step 1. Look at your cessation date, 31st of March 16, and determine in which tax year have we ceased trading. Well, that just about, but it is still within the 15-16 tax year. So there is your final year. We'll then note that and move to the step 2, which is to go back to the penultimate tax year and assess using CYB. So 15-16 is the final year, 14-15 therefore will be the penultimate tax year, and can you pick out there which of those profits will be assessed in that penultimate tax year? Once done and stated on your answer, you can then take any remaining as yet unassessed profits and allocate them to the final tax year 15-16, and then finally deduct those overlap profits. So let's make sure we can carry out that 3-step process again here. So starting point, date of cessation, and that is 15-16. Note it, leave it, go back to penultimate tax year. Well, that must be 14-15, which, as we've said, we will assess using CYB. To what date have we prepared accounts? As we can see there, the 30th of June. So which accounting year ended? The 30th of June will now be assessed using CYB in the 14-15 tax year. Which 30th of June falls in the 14-15 tax year? That, of course, is the year ended 30th of June 14. What profit did we have there? There we go. That's our 14-15 year assessment. It's £50,000. So accounting year ended June 14, assessment £50,000. Right. Step 1, final tax year 15-16. Step 2, go back to penultimate tax year 14-15, assess using CYB. Step 3, now go back to the final tax year and assess as yet all remaining unassessed profits. Look at where we've got to, £50,000. So it's the £30,000 and the £25,000 that are as yet unassessed that will be allocated to this final tax year, and from which then we will remove, of course, our overlap profits. So back to the final tax year, we have got, look where you'd got to for CYB, for penultimate, year ended June 14. So taking it from there, we want the year ended June 15. That is a profit of £30,000, followed by what then is the final period, the period through to the 31st of March 16 there, in which we made £25,000. And finally, away from which we will deduct our overlap profits. And our overlap profits, we're told there, amounted to £9,000. So 30 plus 25, that will be 55,000, less 9, I think that we're looking at £46,000, therefore, as being the assessment, and the task is complete. So look again at the process, that 3-step process there that we have applied. Make sure you're happy with how we have applied it in each of these two examples that we've illustrated. Reason why I've done a second example there, I didn't want you to imagine that you'd always find that in the final tax year there was just one final period of profit. No, that is why we have to go through those steps. What is the final year? 15-16. Go back to penultimate and assess using CYB. That was the year ended June 14. Then allocate any as yet unassessed profit to the final tax year. You will discover that that is either one or, as here, two periods of profit. List them out, take away your overlap, and you have your assessment for the final year. Thank you very much. Job done. So, I'd like you therefore to, again, as I said, have a little look through that exercise, those exercises, make sure you're happy with it, and then back in your course notes to attempt and review through the answer to example 4. So would you please now pause at this point and go and attempt example 4. Review through the answer, make sure you're happy with it before again returning to this lecture. Okay, well, in chapter 4 we saw how it was that we adjusted up the statement of profit or loss to make it acceptable for taxation purposes. And in relation there to the disallowance of the depreciation charge, in chapter 5 we saw how we compute and deduct capital allowances. That gave us, for any given accounting period from when you started to trade through to when you ceased trading, that gave you therefore the figure of tax adjusted trading profit. Here in chapter 6 we've seen how it is we take that tax adjusted trading profit and determine the tax year, or indeed years, in which that profit may form the basis or part of the basis of assessment for. And we now know our bases of assessment from the very first tax year through to getting on to CYB. We stay on CYB through to and including the penultimate tax year, and then we've seen how to determine the assessment for that final tax year. So what you may be called upon to do in an examination question is not just work the assessments given the tax adjusted trading profits, but you, as we said in an earlier session, you may have to compute for yourself what is the tax adjusted trading profit. Now, are there therefore any particular issues that arise here in relation to dealing with the opening years, as we'll look at first, or thereafter final years? And most of the issues that we have concern the calculation and deduction of capital allowances. Hence you'll see here in chapter 6, section 2, the basis periods for capital allowances and how it is we compute the capital allowance, most specifically for that opening accounting period, which remember is likely to be other than just 12 months. So let's have a look at what those rules are. Now, to be fair, we've already dealt with this in chapter 5, so it should be revision. Now, we know that we adjust up the statement of profit or loss for the accounting period, and then we compute and deduct our capital allowances, again in relation to our accounting period. So what have we got? Capital allowances are deducted from profits before the opening year rules are applied, and it's for an accounting period that we prepare the capital allowances computation. Capital allowances are calculated for a period of account, the accounting period, then deducted from the adjusted profit, give us tax adjusted trading profit, and that then we use to determine the assessment for the relevant tax year. So in opening years, in that first period of account, that first accounting period, we may face a short or longer period. Well, that may therefore mean that certain of our allowances need to be time apportioned because they're annual. They're based on a 12-month period. Now we know what they are. The AIA and the WDA are annual allowances. The AIA, annual investment allowance, it's £500,000 based on a 12-month period. If, as we may see, if for the opening period it is short or it is long, you must time apportion. If it's a 6-month period, you take 6/12 of the 500,000. If it is an 18-month period, you take 18/12 of the 500,000 level of AIA. WDAs are annual writing down allowances, again based on a 12-month period. So if we have a 6-month period, we'd only be entitled to 6/12 of the otherwise available 18% for a main pool item, or 8% for a special rate pool item there. So AIAs, WDAs are time apportioned according to the length of the accounting period. Now note there, they're time apportioned according to the length of the accounting period. When you happen to buy an asset within the accounting period is irrelevant in terms of the level of capital allowance that you'll be entitled to. As we have just said, if you had an opening 6-month period of accounting period, if you had an opening 6-month period, then whether you bought an asset on the first day of that period, the last day of that period, or any day in between, the allowances are still based on 6 months of the available AIA or WDA. It doesn't matter when within the accounting period that you buy. What causes a time apportionment of a capital allowance is the length of the period itself. Is it short? Is it long? Net down, gross up accordingly. When within the period you buy, irrelevant. So many times students go and try and time apportion based on the period for which they've owned the asset. No, it is based on the length of the accounting period within which you have bought that asset. So what have we got in our example? Now here we've got a much bigger and better example than that which we faced before. This could be the basis of a question either in section B or section C. Compute Wendy's income tax liability for the 2015-16 tax year. So we're going back to what we looked at in chapter 2, the preparation of an income tax computation for an individual for our tax year 15-16. Here calculating income tax liability. So what are we told happened in the 15-16 tax year? Well, up until the 30th of June 15, Wendy was employed, so would therefore have had a salary, and she was employed at an annual salary of £40,000. Now remember, we want the 15-16 tax year's income tax computation. She was only an employee until the 30th of June 15. That is an annual salary. So for the 15-16 tax year, how many months worth of that salary will we be including? Well, we've got to the nearest month, April, May, June, so we want 3/12 of that annual salary to include within our 15-16 income tax computation. Then what happened? On the 1st of July 15, Wendy commenced in self-employment, running indeed a music recording studio. The following information relates to the period of self-employment from the 1st of July 15 to the 5th of April 16. Well, we've been nice to you here. Again, what the individual has decided to do is to choose the 5th of April as their accounting date. Now again, whether they choose that date or not is not an issue here, because based on the length of that opening period, here it's 1st July to 5th of April to the nearest month, that therefore is 9 months. So any AIAs, any WDAs will be restricted to 9/12 of the available allowance level. The adjusted profit for that period, 1st of July to the 5th of April 16, there is £89,000. But that figure, of course, before taking account of capital allowances, and that's what we've got to do, the capital allowance computation. So let's see if you can remember the exercises that we did in chapter 5. Now, when given a list of additions, if not both additions and disposals, we write next to those amounts the particular allowance that will be available. So 1st of July 15, we purchase recording equipment, obviously for use there within the trade, so that is AIA, and it's a main pool expenditure item, AIA main pool. We've then got a motor car. Now when we buy cars, we're thinking about CO2 emissions. CO2 emissions here are 170 grams per kilometre. But what is also important, used by Wendy, 60% business use, obviously 40% private use. That means that that will be a non-pool asset. We'll have a separate column for that non-pool asset. As we know, anything that has private use by the proprietor, Wendy is the proprietor, we will restrict the available allowance to just the business proportion, their 60%. Now it usually is to do with cars where there's private use, here motor car. And with motor cars, then we know there is no AIA. The question therefore is, do we get WDA, in which case what level of WDA, or do we in fact get FYA? Well, let's have a little look at what those emissions are. Here, 170 grams per kilometre. Now that means therefore that would otherwise have gone to the special rate pool, so we're talking about a writing down allowance of 8%. It won't of course go to the special rate pool because it has private use by Wendy the proprietor. It is a separate non-pool asset. So there's a lot going on there. It's non-pool, 60% business, 40% private use, and given the level of CO2 emissions, just an 8% WDA will be available. The second car purchased in the period, 125 grams per kilometre, so that's between 76 and 130 grams, so there the WDA would be equal to 18%. Again used privately, but this time by an employee. That therefore means that there is no private use adjustment. It's only where we have private use by the proprietor that any such asset is treated as a non-pool asset. So what have we got? We've got a 125 gram car. That therefore would go into the main pool. You know, on cars here, no AIA. That would be WDA. We know it's 18% because it's a main pool item. That's the list of cars, but if of course we had had a car with low emissions, 75 grams per kilometre or less, then that would have entitled it to a first year allowance. Now if we have first year allowances, look back to the note up here. The first year allowance at 100%, this is on cars with low emissions, 75 grams per kilometre or less, well that is never time apportioned. The first year allowance is not based on a 12-month period, it's a one-off allowance. It doesn't matter whether the period in which you purchase the low emission car is 1 month, 12 months, 16 months, whatever it might be, because all that matters is you're entitled to 100% allowance based on the CO2 emissions being no more than 75 grams per kilometre. So you never time apportion FYA. So the rules, time apportion there the WDAs, time apportion any available AIA, never time apportion FYA. There's one final, of course, addition that arose, the computer there, £2,600. Well, that is just normal AIA, and it would be main pool. Now, in fact, whether it was main or special rate pool here is not going to be an issue, given the amount that we've spent. We've only got 30,000 on the equipment, 2,600. That, once we've computed the relevant amount, will be well within the level of available AIA. So we'll get 100% AIA there on. Right. Having denoted on your question page the particular allowances available on the expenditure incurred, and having picked up that the opening period is a 9-month period, we know that we will be taking 9/12 of any available AIA and WDA. So let's put together now our exercise, our capital allowances computation. So this would be a working referenced, of course, then back to other workings and finally through to the income tax computation. But let's do this one first. Again, then we'll build to look at the income tax computation. All right. Do we have any expenditure here that is eligible for either AIA or FYA? Yes, we have AIA available expenditure. You can put AIA stroke FYA if you want, but there are no low emission cars bought. Do we have any assets that will go into the main pool? Yes, we do. So we set up a main pool column. Do we have any special rate assets? No, we don't, but we do have a non-pool asset, that being the car with 60% business use. So we have a 60% business use car. And then finally, of course, as ever, a column to record the allowances of the period. So having set up the columns that we need, normally, of course, you'd look for any tax written down values brought forward from the previous period, but this, of course, is an entirely new period. It's our first period. There are no opening balances. So we are looking at the capital allowances computation. We'd have headed it up, of course, CA comp, and the period here is a period through to the 5th of April 16, that being your opening accounting period. What goes into this accounting period? Firstly, of course, additions, and those additions that qualify for AIA. You would then put a little note next to that, note 1 here, and in note 1, you can show that beneath this computation, you'd be identifying that because the opening period is only of 9 months, you take 9/12 of the £500,000 AIA limit for the year. 9/12 of 500,000 would be what? 375,000, which is clearly well in excess of the additions made this year. The additions in this, I should say, this accounting period there. The additions in this period, that was the recording equipment. That cost £30,000 into the AIA column. And we've also then got the computer. And the computer was £2,600. Total, therefore, 32,600. And on that 32,600, a full AIA 100% allowance will be available. 32,600. That will leave nothing to go to the pool, and the total 32,600 will go into the allowances column. Now, you might have had a quick thought there to think, computers. I remember something about those. Something to do with the short life. Computer equipment is typical asset as being a short life asset. And if you've got a short life asset, then you have available a depooling election. But there's no question here of making a depooling election. Why? Because you're going to have all of your allowances now. You've got 100% AIA. And in that situation, you are never going to make the depooling election. It would only be an issue on expenditure that went above the AIA limit there. So here, it's not an issue. Didn't need to be told about whether or not a depooling election would be made. We'd be expected to know there that given that we've got 100% AIA, it can't get any better than that, there will be no depooling election. So, all of that, AIA, 32,600. So we've dealt with the additions that rank for AIA. What do we now deal with? We now list out those additions that will rank for writing down allowance, WDA, i.e. cars. So we've got 2 cars purchased. Now again, we may be able to differentiate them by name, BMW, Mercedes, whatever it might be there. Here we've got as a basis of defining them the level of emissions. So we've got 1 car that will go to the main pool. That was the car with emissions of 125 grams per kilometre. That fell between 76 and 130. There was no private use by the proprietor, so £10,400 was the cost, and that is allocated to your main pool. But we've then got the car with high CO2 emissions. That was 170 grams per kilometre. Now that would ordinarily have segregated it out into a special rate pool, but this time it has private use by Wendy, the proprietor. So how much was it? cost there £14,800 into its own column. Again, we work logically and systematically through the problem. So we've got the expenditure now that's gone into the columns, the main pool and the non-pool asset column. There's no disposals here in this opening period, otherwise they would have been deducted at this point. And what balances do we have? 10,400, 14,800. And on those figures we can now calculate our available writing down allowances. Now, on the main pool is 18%. So 18%, but we have only a 9-month period. So we will take 9/12 of that 18% in relation to your main pool. So calculators out, £10,400 is the figure upon which the WDA is available. Take 18%. Then multiply that by the length of the period, it's 9 months, so by 9/12. And it is that figure, the time apportion figure, that, check my calculations by the way, I made that to be 1404, that the £1,404 is then the available allowance to claim, and put it in to your allowances available column there. So check that out, put it through your calculator, put it into your allowances available column. We've then got the WDA on the non-pool asset. Now, what was the level of CO2 emissions? It was high, and on that basis we were talking 8% allowance. Again, doesn't matter when within the accounting period you happen to have purchased the asset. The accounting period is 9 months, so it is 9/12 of the available 8%. So calculators out, 8% of 14,800, and multiply that by 9/12. And I got that to be, hopefully I've got the right figure here, £888. Do we get to claim all of that? No, we don't. Now, of course, we restrict that figure to the business use element, 60%. But we must deduct the full 888 rather, and then claim only 60% of that, which again, if my arithmetic is correct, came to, rounded to £533. There were no expenses incurred in relation to FYA assets, no low emission cars. Had we bought a low emission car, then 100% FYA would be available. No time apportion would have applied to it. There was no such. We can therefore carry forward our tax written down values to the next accounting period, and also compute here and deduct the available capital allowances, deducting that, of course, from what is our given in the question adjusted trading profit. Now again, if we add those up, hopefully I've done it correctly, and that would appear to come to 34,537. 34,537. So look at the capital allowances computation that we put together. That's the new bit here in relation to this problem. I would expect you now to be able to carry on and deal with what is the requirement of this problem, which is to determine the income tax liability. Now, to do that, we already know that we've got 3 months of salary to allocate to this tax year's income tax comp, and we now know that from an adjusted profit figure of £89,000 given in the question, we computed capital allowances of 34,537. We will take those away from the adjusted profit to get our trading income for that opening period. Now, because that opening period is through to the 5th of April 16, we're in a very fortunate and easy position indeed, that we know that we started trading on the 1st of July 15. That makes 15/16 the first tax year of assessment, and in the first tax year, what basis of assessment do you use? Actual. What is actual from the start date to the following 5th of April? So you took your adjusted profit of 89, took away your capital allowances of 34,537, get your trading income figure, and that is the actual assessment in this year. You will take that and also the employment income figure into your income tax computation. That will give you total income, take away your personal allowance, get taxable income. Then proceed to calculate the tax at basic and what will also be some higher rate burden. Calculate then those figures of tax. That will be your income tax liability. Again, it was only liability required, not payable. So I'd like you to complete that exercise and then review through that, please, with the answer again at the end of these course notes to make sure that you're happy with not just the capital allowances computation done for that short opening period, where we've time apportioned AIA, not that it was an issue, given the level of expenditure, and we've time apportioned, and it was an issue, the available WDAs there. Deducted the capital allowances from the adjusted profit of that accounting period, and then use that in terms of working out our assessment, which again, given that we had an opening accounting period to 5th of April, allowed us to use all of that on an actual basis in the 15-16 year. Put it together, please, and check through then with the answer in the back. Finally then, in this particular lecture, the issue now pertaining to how do you deal with capital allowances in what will be the final period of trading. Up until then, again, you do your capital allowances computation as normal for your accounting period, your period of account, as we may also call it here in income tax. We, again, calculate the tax-adjusted trading profit, doing the adjustment of profits, calculating capital allowances, and applying your bases of assessment. What happens, though, for capital allowances on cessation of trading? Well, actually, we've done it already. Again, we even had an example on it back in Chapter 5. So I hope you recall that in that final period of trading, there's no WDA, no AIA, no FYA that will be available in that final period. Instead, what happens on cessation of trading and the assets are all disposed of, then a balancing adjustment will arise on cessation and is computed. Now, if it's a balancing allowance, then you've got that is your capital allowance of the period. If, on the other hand, you have got a balancing charge, then that would be added to the adjusted trading profit. It's possible, I suppose, that from the start of that final period of trading through to the final cessation date, it's possible there might have been some additions. If there were additions, as we know, no WDA, no AIA, no FYA. So they're just added to the relevant pool. The disposal proceeds, again, as you know, limited to original cost. You cannot take out more than you originally put in to your capital allowances computation. Deduct your proceeds in order to find the balance. If the net balance is still positive, then a balancing allowance will arise, i.e., if you sell for less than tax written down value, you sell for less than tax written down value, it's a balancing allowance. That is your capital allowance, and as ever, deduct it from any adjusted trading profit of this period to get the tax adjusted trading profit, and then you can use it in your assessments. Whereas, if the net balance is a negative figure, i.e., then you have sold for more than tax written down value, you've sold for more than tax written down value, then a balancing charge will arise at this point. What do you do with the balancing charge? As we said, you would simply add it to the adjusted trading profit rather than deducting it. So you should now be able to deal with, from the start of trade to the cessation of trading, any adjustment of profits exercise required of you for any given accounting period from first to last. You should, for the self-same accounting periods, be able to prepare the capital allowances computations, allowing you therefore to get the tax-adjusted trading profit of every such accounting period. And whether it's the opening period through to the final period of trading, you should then be able to relate that profit to the tax year in which it will be assessed, using the bases of assessment as we have learned here within Chapter 6. There is just, and we'll hold this over until a final and much shorter lecture to finish off this chapter, there is just one other thing then for us to look at, and that's referred to as the cash basis for small businesses. We have been looking at a statement of profit or loss and adjusting it and making it acceptable for taxation purposes. What that demands through the accounting system is the use of the accruals basis. And if you are a non-accountant, then that is something that may cause problems. And the only reason why these small businesses basically need accounts is to form the basis of a taxation charge. So very sensibly, and very generously even we might say, what the HMRC have done in recent years is to allow us to abandon the accruals basis when working profit and simply use a cash basis. Because any trader would keep a record of cash, receipts and payments. So they don't have to worry about the accruals basis. They can simply use a cash basis to work profits, looking at receipts less payments, and use that as the basis for their chargeability to taxation. How we do that, to whom it is applicable, we will look at in our next and final session on Chapter 6.